Welcome to another episode of Good Value by Antipodes.
Welcome to another episode of the Antipodes Good Value podcast. And I'm really excited about today's episode. We featured portfolio managers, macroeconomists, and company executives in the past. But today's guest is an expert of a slightly different nature. I'm delighted to be joined by Antipodes head trader Steve Sevier, who has been trading US and Asian equities in both Australia and the US for the last 20 years. There is no one at Antipodes who is closer to what is going on in markets on a day-to-day basis. So some of the topics we're going to cover are the change in market participants and what that means for market behaviour, as well as what's driving markets today, including areas of froth and dislocation. Steve, it's a pleasure to have you on the podcast.
Thanks, Alison. It's great to be here. So thank you for having me on the Antipodes Good Value podcast. Markets are really interesting at the moment. They tend to go through different periods where an ever-changing narrative drives investor attention, be it inflation, tariffs, geopolitics, Mag 7, or AI. And at the moment, there's so much moving around. It's a really exciting time to be in the market.
So, Steve, two of my favourite things about working with you, aside from our shared love of Cadbury Marvellous Chocolate, which is obviously my favourite thing about working with you, you always find markets exciting and you're unflappable. You have an enormous amount of experience. You've traded through major cycles and events like the 2008 financial crisis and more recently COVID. You've had stints at Macquarie Bank and Goldman Sachs and one of the original Tiger Cub funds in New York that came out of Tiger Management, which was one of the most prominent hedge funds in the 80s. So we could do an entire podcast on anecdotes from your career. So can you give us a few trading stories from back in the day? And, obviously I have to say to you, no naming names, because we still need to get compliance to approve this.
Thanks, Alison. Yeah, look, I've been fortunate to have experienced, many ups and downs in markets over the years. I started in the mid-2000s and a few things that are etched in my memory with the way that Hong Kong moved in the period from 2006 to 2008. So the HSCI, almost doubled in 2006. It started the year around 5,300. It finished over 10,000. That was a big move. It was a particularly big move, when it was, when you were young and fresh and, first looking at markets. But by mid-2007, it had surpassed 20,000. But less than a year later, in late 2008, in the depths of the financial crisis, it was back below 5,000 again. It fell, 70+% from the peak. Now, that was early in my career, and it was a great time to be learning from some phenomenal traders. Importantly, it showed me that you can get in and out of different investments at different prices and still make money. You could buy something, it'd go up 50%, you'd sell it, and you could buy it again at a higher price, and it'd go up another 50%, you could sell it then too, and still make money. And I was amazed at how quickly markets could move and how important it was to be disciplined and have a very high level of attention to detail. It taught me how to handle pressure and to try and think rationally rather than emotionally when things were going wrong. Some of the things that stick in my mind are the obvious: the GFC, the taper tantrum, the flash crash, the chaos of COVID, the meme crazes. But on reflection, there are many entertaining stories from each of those periods, and a lot of the intensity and fun during that time as well. But we'll keep those for another time. I've been fortunate to learn and work with some amazing traders, portfolio managers and investors, my various mentors across the market in my early days at Macquarie and at the fund I work for in New York and others. And they certainly set me up well for the future. With each of those people, I was lucky. We earned mutual respect for each other and for each other's skill sets, and I'm fortunate to still keep regularly in touch with many of them today.
The skill of a trader, really is about being able to think under pressure, isn't it? It's really such a big part of the job. Now, before we get into the nitty-gritty of the market, talk me through your day-to-day. Now, obviously, you're executing buys and sells in the portfolio, but that's not all, is it? How do you support the Antipodes portfolio management team?
It's a great question, and one of the things that is terrific about my role at Antipodes is the crossover with the investment team. There's the obvious job of the trading team to execute the orders in the market, to reflect the decisions that our portfolio managers are making as they shape the portfolio. And ultimately, part of our role is to endeavour to get the best outcome for our investors, and we'll always interact with our orders in the market. We're striving to achieve that outcome. But beyond that, the trading team spend a lot of time interpreting how the market's behaving, how investors are positioning, what we can learn from the way that different markets price the same or similar securities, how different asset classes are behaving, and where money is moving from and to as those market narratives I mentioned earlier shift and positioning and the flow of money shifts with them. From my personal perspective, I'll almost have a view on where I think the market's going. Having a view also gives room for debate in the team, especially if an analyst, or portfolio managers looking at a fundamental 3-year view of a stock, and myself or the other traders are looking at what market participants are saying is driving things here and now, and the stock's falling, quickly or rallying aggressively to capture that and convey that to the team. And that can create opportunities to be interacting with opposing views in the market, as well as facilitating discussion within our investment team. So, we're basically the eyes and the ears in the market for our portfolio managers. So dissecting how we think the market is behaving, what they're anchoring to, and how different investor types are behaving and trading in the market has a real impact on how things can move on any one day. It also allows us to filter noise so the analysts and portfolio managers can focus on fundamentals, and we can then draw their attention to what is driving that price action for stocks, sectors, or the market if things are moving quickly.
It's really interesting, isn't it? Trading isn't a separate function. It really complements the analyst team. Just as you said, it's that combination of the long-term fundamental view and then pairing that with that more immediate market feedback, and then, using both of those to drive portfolio positioning. Pure execution is just really only one way in which the trading function adds value. If we think about the structure of the market, it's changed a lot over the last 20 years. It used to be that the big institutional long-only funds dominated. Can you take us through how market participation has evolved? Who are the big players today?
Yes, you're right. I mean, the market structure has changed a lot over the last 20 years. And if I think back to the early days, I was part of a team that would arbitrage dual-listed stocks between markets. And this was before the days when quant funds or risk-out funds had electronically mastered the art of this. Now, the spreads were wide at that point in time, and over time, those spreads drew many more participants to capture those short-term trades that had high returns for really very low levels of risk. Nowadays, there's so many different types of market participants. There's retail investors, and they're having a big impact at the moment. There's fundamental hedge funds, there's market makers, there's high-frequency trading firms, there's quant funds, there's CTAs, there's derivatives traders, there's momentum-following funds, and there's long-term fundamental investors, and of course, there's passive investors as well, amongst others. And all of them are active in the market on any given day, and each of them can certainly impact the way that a stock or a security is behaving. So market makers, liquidity providers, quant funds, and high-frequency trading firms are really big players in the market today. Those types of funds are now about 50% of trading activity on any given day. And that number is relatively capped because once they get above that level of participation in the market, they start to eat each other's and their own lunch. Retail investors are also a big proponent of daily turnover in the US market, and they've been a growing participant over the last 5 years. Things really took off, during that COVID period when people were stuck at home and had access on their computers or on their phones to trade, and that really brought retail investors to life. The way the options markets evolved in the US as well has a big impact. So if I think back to when I first started trading options, they expired monthly for the first 3 months, and then they expired quarterly. Now their expiry is daily and weekly, and they can really move, the way that a stock's behaving. They can impact turnover in single stocks, and it's most evident in the US market. That became particularly obvious during the meme craze, when short-dated options were a big part of what was driving things. Interestingly enough, though, each of these investors can create mispricings in the market, and they create opportunities for fundamental investors like Antipodes. For example, as I mentioned, the exuberance of that meme period, drew retail investors into markets, momentum funds endlessly buying price momentum, or in down periods selling price momentum with little regard for valuation. Passive investors also, that are forced to chase index returns and index constituents, which can leave behind index underweights or overinflate highly indexed securities. There's a lot going on with the market structure and microstructure on any given day.
Yeah, that's actually really quite amazing when you spell it all out like that. I sit there up at Antipodes with the team, and really, markets have become so much more complex than when my career began, and they're so much more complex than I even realised. I think what really stuck out for me, the last bit of your answer there was just how much quant funds and high frequency trading, 50% of trading activity on any given day. I mean, that's huge. I certainly had no idea. So, what are the broader implications of this change in structure? Are we in a much more momentum-driven rather than fundamentally driven market? And what does this mean for the investment horizon of the market? Has it shortened?
It has shortened in some respects. And the reason behind that is a lot of these investors are quite trigger happy to price action. So when things change, they change direction quite quickly, when prices change. And so if you think about the setup in behaviour of CTAs, and in quick terms, a CTA is, but the one that comes to mind are the trend following investors. So they buy in the market as it's rising, and they keep allocating risk as price moves their way. So as momentum and price action goes up, they keep getting longer and longer. And what that does is it can result in a big buildup of risk. Now, that's okay if the market keeps going up, and the market can trend for long periods of time. But when that breaks, that can result in quite a substantial increase of volatility as they're forced to de-risk. Now, they're usually rules-based investors, so they liquidate very quickly to cut losses or lock in gains. If their model says time to take your money out, they take the money out. Now, that can create pockets of volatility when markets turn, as the magnitude of those flows can be very large. Retail investors similarly have been active buyers of the market for a long period of time. They were large buyers out of the lows of COVID, as I mentioned earlier, and they turned sellers in the period when the Nasdaq moved lower in 2022. Now, since that October 22 low, they've bought a similar amount to what they bought during that COVID period. And it's meaningful dollars, tens and tens of billions. Now, interestingly enough, it appears as if the bulk of the more recent retail investor buying has been buying investments in ETFs rather than buying in single stocks like we saw in the pandemic. You talk to people about, what retail are doing, and some people compare the level of retail participation to, what we saw around 2000, 2001. It's, it is larger than that at this point. But the structure of that's changed as well. In 2000 and 2001, there were no iPhones or, smart devices where you could click a button and be online instantly. Retail investors couldn't trade themselves. They had to trade through a broker. They still do, but it wasn't something that you could pull out of your pocket while you're waiting at the train station. So access increased, and as a result, participation has increased as well. Now, when market cycles turn, many people don't believe things are changing or have changed because they're so used to that existing trend. And so you tend to see positioning very long at the peak of bull markets and very underinvested at the bottoming of bear markets. When the vast majority of people I talk to have the same view, it's usually time to start thinking about taking a different view, even if that's very short term. Now, if you think about performance of markets in just the last few months, for example, most people would have been surprised that China and Europe have performed very well relative to the US market. Most would not have expected that, and being able to time markets is very, very difficult. But understanding investor positioning and psyche can help with making decisions with conviction that aid to the fundamental views that we have at Antipodes.
That is interesting and actually quite surprising, and something I do want to come back to. But before we get onto that, since we have such a large proportion of the market buying trends or buying momentum, what can change the current momentum in the market?
Yeah, a lot can. And markets are very intertwined these days, and positioning can play a big part in exacerbating market moves, and triggers for price breaks in price action can be caused by different things. For example, political shocks, earnings changes, economics changes. If you think about last year, in August, you had very large moves in Asia, and things quickly unwound from a positioning perspective. The setup was largely the same way. The dollar yen fell from the mid 150s at the end of July to the low 140s by August the 5th. You had the Nikkei 225, which is the equity index for Japan. It fell 20% or almost 20% in 3 trading days. So some of the unwind of that, carry trade in dollar yen carried through into equity markets, both in Japan and then globally. The Nasdaq fell, call it 10% high to low in that same few days. Earnings misses or beats can have a similar impact. If you think about some of the size of the individual single-day moves in large-cap tech stocks around earnings results over the last few years. And then politics become, quite interesting. If you think about the French political setup late last year, it created volatility in the market there. And that presented a real opportunity to be adding to the French exposures in that period. For example, one of our French holdings, the bank SocGen, had rallied from sub 20 euros to almost 40 euros in the 6 months since that period. Now, part of our role as traders is to be aware of the setup into those types of events and then assess what's happening in the market, how investors are behaving, and to help our team understand what's happening in real time so we can form a view and respond as things are evolving quickly. At the moment, the market's moving less on inflation than it was a few years ago and more around the growth propensity and employment. US rates markets to this point have had less of an impact on the equity market than they did in recent years, for example, but that can also change quite quickly. I think the market's focused on the outlook for earnings growth, the broad economic growth, employment, and then what's really happening in this, Chinese and Western technological race at this immediate moment.
We know that market concentration is at extreme levels, and we know there's heavy positioning in US mega-cap tech. Where else do you see some of the big dislocations in markets, whether that's crowding or washed out positioning?
Look, that's an interesting one, Alison. And if we think about how the market setup is at the moment, or at the time of recording this, I'll focus on the more reactive short-term investors as they have the capacity to move markets. Hedge fund gross exposures are currently high. Hedge fund net exposures are relatively high. So investors are quite long and they're highly leveraged. Trend following or momentum following CTAs are almost max long in S&P 500 and the NASDAQ as of the end of last week. But the triggers for that to change are very close. So if the market goes up from here, hedge funds, CTA investors, those that tend to respond very short term are quite full. And so is retail. Now that creates some asymmetry if things were to move lower. Now, there are a few things that are changing at the moment. Volatility is starting to go up in some of the well-held retail stocks, and that volatility is going up both on up days and on down days. Bitcoin's moving around. There's a rotation going on in the large cap tech part of the market, most pronounced around the DeepSeek announcement. So what happens, if retail reduce the amount they're buying or they turn net sellers? You've got an interesting setup in the market where the risk return in the very short term is tilted to the downside. Now, that applies to any of those investor types and also, applies to large fundamental investors as well. Now, many of these metrics have been at this level for some time. People have been well invested, for a long period of time. So the catalyst for timing turning points in the market is very, very difficult. But if things do turn, then you've got a lot of positioning all the same way. And as we've seen before, and if you think about the moves in Hong Kong and China in recent weeks, which was basically the opposite to what I've just described, positioning was very under-owned or short. And so in that instance, the risk was to the upside. The market can move very, very quickly to reprice and rotate. About a month ago, you had this setup at its relative extreme. Now, positioning has come back a little bit as you've seen some rotations in the larger cap tech part of the market. You've seen rotation in the currency markets, and you've seen some sector rotations as well. And in Hong Kong and China, you've had a meaningful rotation into larger cap tech and Hong Kong and China AI exposed stocks. But each of these have the potential to continue. So I'm continuing to closely watch intra-sector and inter-sector rotations, broad positioning across the market, and what's playing out in the dollar credit market and the rates market.
It's such a good reminder. We talk about FOMO, in the markets, that fear of missing out. And when you have so many participants positioned the same way, that's what leads to those record price moves. It's the rush for the exit. It's that classic analogy that, many investors will be familiar with. But I think, you raised such an interesting point earlier around those China-Hong Kong moves, is that it also exists in the opposite direction where positioning is incredibly washed out. And then you get a little bit of good news and you can see very sharp moves up. And, and to that point, and revisiting that comment you made earlier, it is interesting and I think surprising to many investors, well, I think it's probably surprising to many investors, that Europe and China have outperformed the US over the last few months since the US election. What are you watching that could signal a much more sustained rotation in positioning?
Look, as we talked about, the moves in Europe and Hong Kong and China in recent weeks and months have surprised many investors given the relative outperformance versus the US. If we see a broadening out of the rally that in Hong Kong and China, as I said, has generally been focused on AI-related names and large-cap tech stocks, then this could see a more meaningful rotation and a more meaningful move higher. Now, I'm not convinced that the setup there is that there are enough true believers at this point, and that might create an opportunity. But it does seem to be a more concentrated and less exuberant rally than what we saw in the middle of last year, which was more of a trading market in Hong Kong and China. The other thing is if you see a stable relationship between the US and China and tempered expectations around economic sanctioning, tariffs, the hostilities that they've had, then you could see a more sustained rally in Hong Kong and China as well. So it's quite a complex setup at this point. But if it aligns with fundamental dislocations, then you both have fundamental investors and short-term investors closing underweights or short positions, all moving in the same direction at the same time. And as you said, that can be very, very powerful.
So final question, Steve. The Trump narrative really dominated in recent weeks. Are you surprised by the market's reaction?
I am. I didn't think too many investors were expecting Hong Kong and China to outperform the US to start the year. If you think back to when the election was in November and when the inauguration was, there was a relatively bearish tone towards Hong Kong and China coming from the US. Now things turned. I think that was driven more by the DeepSeek moment, among other things. When the market realized that China is actually undergoing its own tech internalization as well. The tariff situation thus far hasn't been as severe as some may have expected. And it's interesting to observe some Chinese and US companies either collaborating or publicly using each other's products, something they've tended not to highlight, in recent years. But this is all going to take a while to play out. And it's very, very early days, and this can change very, very quickly. Most things are far away from where that hawkish narrative was that, the market was probably expecting post the election. And it's probably more hawkish towards US neighbours, Canada and Mexico, than many had expected at this point. Again, that can change quickly. But, for the first 6 weeks of this year so far, I think most investors, would be somewhat surprised by the market movement relative to how people were positioned and where people thought things were going to go.
Steve, we'll wrap it up there. It was an absolute pleasure having you on the podcast, and thank you for taking the time to share your insights.
Thanks, Alison. It's always a pleasure to catch up, and thank you for having me on the Antipodes Good Value podcast.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.